Hey folks, welcome to Pro Trader Strategies. My name is Eric Wilkinson. This is swing trade using options. So what we're going to talk about here is some simple concepts around options and then build on that to real life examples. By the end of this, I'm sure you guys will have a pretty solid understanding of options. So before you go, make sure you smash that like button, especially if you ever get that light bulb moment going off, please hit that like button for me. And throughout this video, if you have any questions, comments, or anything else, throw it over there in the comments section. I want to make sure you folks are clear of concept before I ever move on. So don't be shy. If you have a question, somebody else out there probably has that same question. So feel free to reach out over there in the comment section. And before you go, subscribe and hit that little bell right next to it. I'm doing spotting the trade videos where you never really know when I'm coming on. Yeah, we have it kind of scheduled for a certain time, but it's really when I find an opportunity in the market, I'm going to come on probably more likely than not unannounced. So make sure you guys are hitting that little bell next to the subscribe button. All right, like I said, this is going to be swing trade using options. These are more exotic strategies. We've done them on bullish, bearish, market neutral, and we've even done some of the adjustments showing you how to adjust a trade that's not necessarily working out. Well, we do that in all of those. These exotic strategies are a little bit more detailed, if you will. So there's a few extra nuances to these strategies that we're going to layer on to some of the old strategies to create these exotic ones. All right. And it's really not too exotic exactly. But at the end of the day, I first want to talk about swing trades. And we are going to get around to this ratio call spread. That's the exotic trade that I'm talking about. The ratio call spread is just a long call spread with an added short call to it. But before you go out there and just start implementing this strategy, let's find out what those rules are that we're going to be talking about, because they're not necessarily rules. I'm not hard lined on these rules. What I try to do is create some guidelines or some rules for you folks to follow in order to determine what's the best strategy. Okay. So with this one, I'll go through some of the scenarios that I go through in my own head before I really go drilling down to the ratio call spread. Okay. We've talked about this with these swing trades, how to determine what strategy throughout with volatility and all of those things. This is going to be along those lines, but the ratio call spread is really going to have to do with our directional assumption. And I'll dig into that here in a moment. Before we do that though, let's talk about swing trades and what is a swing trade. You guys are probably like, Wolfman, what the heck are you even talking about? I thought I was watching an options thing and you're talking about swing trades. Well, yes, give me a second because I want to talk about simple concepts before we go to those real life examples. That's how I'd like to teach. And if that's something that strikes a chord with you, that resonates with you, make sure your guys are smashing that like button and hitting the subscribe. All right. So what is a swing trade? Ultimately, what we're looking at is markets that move in a bullish direction, a market neutral direction, or possibly in a bearish direction, right? That's one of the first things we want to do is identify the overall trend of what this underlying is doing, right? And we determine that by looking at the market, how it goes in waves, okay? And on a market neutral, we could see it where it goes in waves, okay? And then on a bearish one, you're going to see these waves, right? So those are things we're going to be looking for kind of in an overall picture of a underlying. It can be on candlesticks, it can be a line chart, however you like to do it. What we're trying to do is just determine where these resistance levels are and support levels. And we can tell that by seeing where this underlying loses its momentum on the upside. And what we're going to do is draw kind of dotted lines in there, trying to hit as many tops and as many bottoms. Sometimes you'll notice that my line goes through that. I'm just trying to hit as many of those as I can. So we could draw it like that and again like that. All right. So that is where your support and resistances are. So the first thing we did was determine the trend, the overall trend for the, let's say, year, week, or whatever time frame you're looking at. But I usually look at daily, so I'm looking at a full on year. And then I try to find by glazing my eyes, using Fibonacci's, however you do it. I usually use Fibonacci's or even these trend channels where I'll draw them in myself. If you guys look at my SPY trades that I've been putting on the spotting the trades, you'll see my trend channels there. So I put in some trend channels. That's where my support and resistances are. So that's the second step. First step, the trend. Second step is these support and resistances. Where does it lose momentum to the upside, gain support on the downside, right? And then the final thing we're going to be looking for is what is happening right here. That's the pattern. What is the pattern doing right here and right now? Because the pattern, this third step, this pattern is what we're going to set our strategy up on. All right. It's not the overall trend. It's not the support and resistances necessarily. We'll actually layer in the support and resistances a little bit there. But ultimately, we're looking for a reversal in trend. And what are we looking for when we're looking for those reversals in trend? One thing that I always look for are certain types of candlestick patterns. And one of those is going to be like a hangman doji. It's going to kind of look like that. And this can be at the high or at the low end of a move. And we could be looking at a spinning top doji. It's going to have a very small little wick at the bottom here, a hammer we could look at. So that's not going to have a wick at the bottom. And keep in mind that these colors could be green as well. So they don't always have to be red. They could be red or green, or sometimes they call them the white candles. It doesn't matter what the color of the candle is. We're really just looking for candles that look like those. This is a tombstone candle right there. That is a pretty big one, usually seen at the top or bottom of a move is what we're looking for in that. So overall trend, support and resistances, and then finally that pattern. We're looking for some of those candlesticks at the top and bottom of moves in order to determine that pattern reversal. And one of the first things we can look for here with the pattern reversal, let me move that out of the way, is that candle. That's one of those candles I was just talking about, right? That's something I would look for at the top or bottom of a move. There's another one right there. That's something I would be looking to key in on for tops and bottoms of a move, right? So those are some of the candles I was talking about, right? And in this one, if I'm looking at this as an overall trend, I can see this overall trend is very market neutral, right? Then the next thing I can do is either glaze my eyes, use these Fibonacci's right here. I've got Fibonacci's in there. You can see those, right? And then I'm going to kind of glaze my eyes and just kind of how it goes up and down, right? But we can see that this is a major resistance area, right? That's one of the first ones. This is a resistance area. I don't know if that would call a major one. I'd say that this is probably a major one because it doesn't very often break through it. So if you have a lower, and this was a little bit more of a less risky one on the further side. So if you're looking at one of these extreme Fibonacci's there where it rarely touches, you're not going to have a whole lot of opportunities. But you'll probably keep yourself out of a little trouble if you're learning to trade, all right? So maybe suggest to go further out when you're first starting with these trades, and then tighten it up a little bit to that tighter resistance area as you get more and more comfortable trading, okay? But then we've got that. We've got our overall trend. We've got our support and resistances, and then the pattern. I would be looking for, if I was a newer trader, a confirmation. So a red candle that confirms, just a dark red candle that drops like this one here. That's what we would look for the next day. Confirmation. Again, if you are newer to trading options, lower risk tolerant folks, wait for this confirmation. I am one that has a higher risk tolerant appetite. I will usually get involved on this, what we call the setup candle. The setup candle is that one that looks like a hangman, looks like a spinning top, okay? Those are what we're looking for at the top and bottoms moves. There's a lot more combinations that we can talk about going forward, but I'm talking very basic right now for you folks that are trying to learn to expand upon your trading regimen. Could you make that chart bigger and lower the size of your face? Oh, for sure. It's really huge. Head, move the head. There we go. Is that much better? Appreciate you, John. Thank you for letting me know, because I do make mistakes all day long. So folks, if you see me making a mistake, kind of like that one, let me know, because I will try and make sure that we're clear on that. All right, so we're looking for something like that with the setups, all right? Now, a lot of folks will get involved with these type of trades using stock. They can get long stock, short stock, or the ETF. We could be talking futures. Those are a little bit longer or easier to be longer and short, right? So shorting something like one of these things with swing trades can be very dangerous, because remember, a lot of folks will say, hey, I can make more money trading the future than I can the options, Wolfman. And that's very true, but you can also lose a lot more using stock than you can options. And you're also really close to the market. So even if the market goes in your direction, or well, let's say if the market goes against you with the stock or ETF future or something along those lines, there's no real way to adjust that trade. We just talked the last time on how to adjust some of these trades. You can't do that with a stock or future. You also have higher probabilities using options, and I'll talk about some of that. I'm getting a little ahead of myself first. But why options? Well, here you go, Wolfman. You just got ahead of yourself. Well, what we're talking about with options, some of the reasons are, I just mentioned one of them, is if you're using stock versus options, the options are going to carry less risk. Almost always. And the reason why is it has to do with probabilities. And I'll go into some of this a little bit further. It's going to be less risk than using the stock, ETF, or anything else. It's also going to be less margin. All right. When you buy a stock, you usually have to put up 50% of what that is. So if it's a $100 stock, you got to put up $50 for every one lot that you do. And usually we're doing 100 lots, right? So rather than 10,000, you got to put up 5,000. All right. Well, with options, I show how you can use options in lieu of even the straight stock, ETF, or future. We build it so it acts exactly like it. And even still, the options margin is less than trading on a margin account. So much less margin. And what's the other one? You're going to be less stressed. All right. Why are you going to be less stressed? Because you're knowing the probabilities of this trade working out or not working out. You know, when you're doing it with stocks or ETFs in a situation like this, we didn't wait for a confirmation on this trade. You know, if I was short this stock on this trade, that's where we were looking at on the previous chart, right? Well, I didn't wait for it to get confirmed and the market shot higher. That would have been an immediate losing trade for most people. But we set this up according to my guidelines that I set out there, and we had a bearish assumption on this trade here, all right? I did, at least. I'm not going to say everybody did. Some people might have been calling me dumb. Well, they proved me right, I guess, or proved me being wrong and them being right, in a sense, because I got the directionality completely wrong. But because I went along with my guidelines for creating these strategies, we had high volatility and able to sell some short calls up here at the 140 level. So we were well above another Fibonacci, or actually, I'm sorry, I made a mistake there. It was the 137 strike, actually, because I was very close to getting tested on that. And, well, I did get tested on it, but not really very much. It just was like a blip up there one day. And then the next day we started rolling back over. But because I got the short calls, directionality completely potatoed. I completely blew that, right? Well, the thing is I used high probability strategies and turned the tables into my favor. Directionality? Nah. but the strategy, ding, ding, ding. All right. So those are things I'm looking for. I don't think that I am always going to call the right direction, but what I try to do is build these strategies so that when I potato or fall on my face by completely blowing my strategy or blowing my technical analysis, which most of us will do throughout our history because technical analysis doesn't always work, right? Well, this is a perfect example, and pops through to the upside, but I still made money on this trade. It was still ended up being a winner. Yeah, I took a little bit of heat on it, but not nearly as much heat as the person that was short that underlying. There's probably no way somebody rode that out 2 days in a row. But when you're short options well above where that underlying ever traded, you never really have that angst. Okay, so that's what I'm talking about. You're going to be able to keep your powder dry. You're not going to be making split-second decisions necessarily when you're trading futures. And I always say I'm a recovering futures trader, folks. Is when you're trading futures, you get in and out, and it just becomes like a video game, right? Well, with options, and the reason why that is because you're emotionally tied to that money going in and out. With options, we can look at it as probabilities, and those probabilities will help us keep our powder dry, or at least keep us within ourselves, all right? So if that's some information that helps you out, please smash that like button. All right, so this is the one I'm looking at right now. The markets have been crazy lately. It's hard to find a bullish strategy. Don't get me wrong. A lot of the world is falling apart again, it seems like. Well, gold is always our friend when something like that happens. So I was looking at gold, especially with inflationary worries right now. Gold is the store of value in that sense. And a lot of folks might be banging at me saying, hey, dude, you're off your rocker. It's now Bitcoin, Ether, and those names. Well, that very well may be true, but gold is still a good holder of value, and there's a lot of participation in there on a daily basis. So I'm going to go to the GLD, which is the ETF, the SPDR ETF for gold, and I want to play this to the upside because ultimately what I've gone through is my swing trade analysis. What do I have? I have a pretty market neutral underlying, right? It's right there at the point of control. I can kind of draw my lines in here to get my, what the trade looks like. And I can find that this is a nice little support area right there. I found that, yeah, it breaks through sometimes. And anytime it breaks through, folks, the one you want to resume the entry into your trend or back through your support is when you would enter that trade. So like on situations like this, you wouldn't want to hit it when it hits right on your point or right on your support level. Wait for it for one of those candles that we're looking for, right? Those are the kind of candles we're looking for at the top and bottoms of moves, all right? Now, we got one actually today. I was working on this last night thinking I was going to get in here. I thought we were going to get a little more follow through today with the downside. We got some support here. A lot of talk with the Fed taper. Folks are realizing maybe this might be a little bit overblown with this variant. So a little bit of reprieve today. Again, I've been talking about these dead cat bounces in the market. That's when we get the big drop. The next day we get the big pop. And the next day is a big drop. Well, that is the market really battling it out, trying to find direction here. And we haven't discerned whether or not the bulls or bears have won yet. They are still battling it out. Nobody's given up because we keep getting this back and forth action. Until that kind of passes, folks, and we really come up with a direction, I would say your risk is still to the downside because it seems the market is very much on edge on this teeter-totter. It's like on a knife's edge for the teeter-totter, and I'm afraid that might just fall like my pen. So with that said, I don't want to necessarily get involved this early on a bullish assumption on just about anywhere. So with that being said, I'm looking for gold as a store of value. If the rest of the market starts falling out of bed, folks are going to be pulling their money out of the stock market with both hands and sticking it somewhere. And usually what they do is they throw it into something like gold, just as a store of value. And especially when the inflation is the thing that is driving the fear, then folks will go to gold, because the idea is that if the dollar weakens, then the strength of that underlying will increase. Okay, so we'll be keeping an eye out for that with gold. So I'm looking for gold as a bullish move. Now, one thing I want to note also is when we're looking at this with a bullish move, we always talk about this down here is volatility, right? And I need to actually know where volatility is before I put on any trade. And for some of you folks, I know you guys have learned this now, but for some of you folks out there that are a little bit newer to the way that I teach, is that we look at volatility down here, implied volatility, to determine what our prices are. You might be like, Wolfman, I don't know what you're talking about. I don't see any prices down here. There's no prices down here. No, there's not. But what we can do is every underlying has its own implied volatility coefficient, if you will, meaning kind of like these sideways trending stocks that we've been talking about. Implied volatility for an underlying usually has a pretty finite range on the resistance to the upside and support to the downside. So what we can ascertain for that, or what we can take away from that, is that when it is at those extreme highs, that volatility is at some of the highest levels we've seen, and that correlates to the pricing. Okay, volatility correlates to the pricing. We know when volatility is at extreme levels for any given time of the year for this underlying, that those prices are the highest level we've seen all year for that underlying. Okay, now I'm not talking about this number in particular, 18, for just implied volatility in general. You can't look at just implied volatility data point and say prices are expensive or they're cheap. What you have to do is look at that number, this number, in relation to the highs and lows. And I'm only going back 6 months these days because of what's happened during that pandemic. We might reach some of this volatility, but I doubt it. So I'm kind of cutting out everything outside of 6 months. So basically any of this stuff this way, I'm discounting from my data. All right. So what I want to do is look at the data for this side and determine my support and resistances there. Okay. To determine if they're high or low. And we can see on that chart, they're relatively high for that underlying. So when the volatility inflates, we know that the prices are expensive or cheap, because that is the main driver of the pricing in the option montage. Now, some people might say, well, time is, Wolfman. If I look out there at March, it's a lot better than December. Well, you're right. You're absolutely right. Their prices are more expensive, and that's due to the time. But what I'm talking about is for that specific even month that I know those prices are at elevated levels compared to what they would be if they were lower. So we know that the pricing is either extreme high or extreme low based on that volatility, okay? And this is a bell curve. And if you're wondering why I have a bell curve, there's a lot of reasons. Bell curves and these percentages really relate to delta, okay? So when we're talking about a 1 standard deviation move, and a lot of you folks have probably seen this type of chart here or curve, this is what we used to talk about when we were in grade school, right? This was the bell curve. You got graded on a bell curve, and that meant that so many people got A's, which, you know, basically the A's would be outside of maybe a 2 standard deviations. This is all the B's, and then all the C's are inside of here, right? And then that's probably close. D's and F's, right? So that's kind of the breakdown there. The idea here really is that you want to have the most amount right there in the middle. So the idea is if this is 0, like the underlying is currently right here, what's the probability it's going to move higher or move lower? And we know this from trading that when you buy a stock or sell a stock, ETF, future, whatever you want to call it, your probabilities of being successful on your timing of that trade are 50-50. Meaning after you bought it, it can go up or down, and the probability is 50-50. But with options, we don't call it probabilities anymore. We call it delta. And delta tells us a lot of things. It's data, is what we used to call it on the floor, because it tells you so many different things. It'll tell you probability of being in the money, probability of touch, how much it's going to affect your premiums. Okay. So the idea is that I want you to take away from this, delta is your probabilities. Okay. So, the probability of a half a standard deviation going this way, basically we're talking about a half a standard deviation is about a 34% probability. Why? Because we're adding up this 15 to there, that 15%, that 9%, that 4%, that 1.5%, that 0.5%, right? So all of those adding up going this way is 34%. Okay. Same thing over here. This would be 34%. If you're looking at the puts, this being puts and this being calls. Now, if they were the calls, right? If I was just talking about calls, these in the monies, this in the money call would be a 66 delta, okay? Because the calls and the puts are just opposite, all right? If you look across from the calls and the puts, you'll see that you added those two deltas together, they would be very close to 100. It's not always exact, folks, but it's very close, all right? So, and then that would be a 66% probability if it's the calls for the puts, all right? Now, with that said, what I'm trying to do is pick the strike that is right at the money, and that's what we call at the money, is the one is right there at zero, and that's a 50 delta, or as close to a 50 delta as we can get, all right? Because it's 50% that way, 50% that way, right? 50 delta, 50% probability. And for every dollar that underlying moves, my premiums will be affected by that corresponding delta as well, all right? Just to be clear. Now, something with this underlying that I want to say is that when this is normal volatility, this would be a volatility. We're right in the middle of remember our little volatility curve, and it was kind of up like that. Well, if volatility was right in the middle at this point in time, our volatility curve would look like this. If our volatility was at this extreme high level, what happens is I like to think of it as like a bucket is on top of our bell curve, right? And if the bucket is half full of volatility, it's normal. What happens when our bucket gets completely full? Well, our volatility curve will get really stretched out. That means the bucket is really heavy. It's like completely full, all right? It smashes down that curve. Now, this one standard deviation that was originally maybe in here, now that's going to be out here. It gets pushed out further. The probabilities of a bigger move are more probable. And if that volatility bucket empties out and there's no volatility in it, it's going to look like this. And again, that bucket, it's the same bucket, but now it's empty, all right? And while it was our old standard deviation, one standard deviation might be out here, now it's way in here, okay? So as volatility fills up, it smashes down the volatility curve and our prices increase across the board. All the prices increase across the board. So when volatility is at its highest, we need to think those premiums are expensive. And what happens when something's really expensive? Do you go running out there and buying it? Or are you thinking, God, it's really expensive, I need to sell it, right? And you can short it. You can sell volatility is really what we're trying to do here. Is when we sell volatility, we're selling options, all right? But you're saying, we got a call spread in here. Well, it's a ratio call spread. It's a long call spread, which is usually used with low volatility. But because we have high volatility and I've got this bullish assumption, I'm worried about down. I don't want to lose any money on a directional move wrong. I'm going to layer on a short call against it, all right, against my long call spread, all right? Because we don't like to do long call spreads with high volatility, right? because when volatility is high, it's expensive. We don't want to be paying a debit. You never want to pay a debit when volatility is at extreme levels. So in this case, we can see that the volatility is at an elevated level for this underlying, right? We can see that this underlying had a tendency to, actually, let me see if I can do a line here. Yeah, I want the line. Oh, I can't get a line. Anyway, so, you can see that that's at an extreme high level, extreme low level. We want to pick those highs and lows there. We can see it at a high level, so I know that those premiums are expensive. Now, if you want to figure out what the pricing is on, or the exact level, what you can do is you take the current implied volatility and subtract it by the low volatility of that chart down there. All right. And then you divide that by the high minus the low, high IV implied volatility minus the low implied volatility. And you can find it all on this chart at the bottom here. So I would need to draw a line here to see where that high is. I'm going to call that 19, and the low here, I'm going to call, let's just say 15. So the current, I have 18 minus the low, which is 15. And then what I'm trying to do is determine how far this is off the bottom to the 18. So I've got the high and the low minus each other. What I say, it was 19 minus the low, which is 15. So I'm going to get 3 divided by 4. So basically it's in the 75 percentile. I think it's actually higher than that. Last I checked, I think it was like 85 percentile. So that means anytime it's above 50, anytime you do this math and you get above 50, that makes you think I need to be selling options. Anytime it goes below 50, that's when you're thinking I need to be buying options, okay? Everybody pretty clear? Make sure you guys are commenting over there on the side. If you have any questions, please. Or if I misspeak, listen, I've been known to say the wrong thing. And if you catch me, please let me know. Throw me under the bus. I'd be happy to. If you throw me under the bus and it saves somebody else from getting thrown under the bus, then I'd be happy to do that too. All right. Make sure you guys subscribe with the little bell down there before you go. All right. Why is that not working? I didn't want that. There we go. All right. So now when we go over to this option montage, this is what I'm talking about with the pricing. When we're looking at this pricing over here with that 19, it's a little bit higher than the other one, which is why my math was a little bit higher. I thought it was a little bit higher anyway. What we talk about with this is all the Greeks, like delta is considered plus $1, all right? So you think about delta as being plus 1, right? Theta is plus 1 day. Vega is plus 1%, all right? So all of these numbers in these columns correspond according to the assumption. You got to think about this part of it as maybe geometry when you had to memorize some rules. Well, your only rule here to memorize is the Greeks are assuming an advancement, okay? So the underlying moves higher by $1. A day goes by. Volatility moves up, all right? You have to adjust your thinking just a little bit when things start going down. And you have to think, okay, a negative, like if the underlying move down, a negative move plus a positive delta here. This is a positive delta. A negative plus a positive delta makes that negative, okay? Same thing over here. If I looked at this, at the underlying move down, a negative plus a negative equals a positive to the premium. So if we started moving down, 51 cents would go in there. If we moved higher, 51 cents would come out of those. Does that make sense for everybody? Anybody have a light bulb moment? If you did, hit the like button. All right. And Vega is 1 percentage point increase. So we can see that this volatility is going to go into our premiums if volatility increases. All right. So we know when those volatilities are at their highest levels, they pumped full of volatility. Now what we're looking for as a trader is to sell those premiums high. And if just volatility comes out, volatility starts going down, you could see all of these become negatives. If volatility comes out across the board on the calls and the puts, they're all just going to go negative to come out of those premiums, right? Because a negative move in delta. So 1, 2, 3, 4, 5 percentage point moves down, you start multiplying these times 5. Like if it moved 5 percentage points down, it's times 5. That's major, right? That affects premium faster than theta. You got to wait a whole day for another 8 cents to come out of the puts and the calls on theta. That's a long time to wait. 50 cents for delta. I've got to get a full dollar move in my direction, like my proper direction. I can't be wrong. All right. Volatility, if I catch it at a high level, I know it can't go much higher than that. Yeah, it can go higher, and it will sometimes, but it doesn't usually. It usually gets up at those high levels, and it's like the market starts realizing, hey, this is expensive, and starts coming back down a little. So we're looking for when volatility is high because those premiums are just chocked full of Vega. Sorry about that. All right. So the first thing, my thing is going to maybe cut some stuff off here. So I might have to rejigger something here. Anyway, I want to set this up because I like to look at buying the call that is at the money. So that's going to be that 50-ish delta. Little caveat with this strategy, you're probably going to have to pick that 50 delta and then go a little bit higher on the delta or into the money a little bit. So maybe a little 50 plus delta. That's where we're starting out. The next thing I want you to do is look at the price, right? You buy a 1-lot call, it's going to cost you $2.62. Now, I need to figure out how to pay for this. Because with the ratio call spread, if there's nothing you guys walk away from today, when you build a ratio call spread out, it should never be for a debit, right? If you ever make a ratio call spread or build out a long ratio call spread, it should never be for a debit, right? It's a long call spread, but no payment out. All right. We want to collect a credit. We want to put this thing on for free or collect a credit because I want no risk if I'm wrong. So $1.62, if I'm looking at this as $1.62 and I need to pay off that $1.62, how can I do that? By selling 2 of something. Anybody know what strike I would go and try and sell 2 of to pay this off? That's right. 69 strike. Look at that. If I sold 2 of those, that would be right around $2.60, right? So let's flip it over. If you're building out the call spread, this is how I would suggest doing it. But look, we still have, this is a 1-by-1. This is just the call spread. And it's a $3 wide, paying $1.28. But I haven't paid it all off. So if I sell another one of these plus one more, actually sell one more, I should say. Sorry about that. If I add another sell of 1, that will add in another credit of $1.30. So when we roll that in, we can see that I sell another one. So now it's a 2-by-1, right? Still buying one of these. You're buying one of these and then you're selling 2. Buying 1, selling 2. So the 2 I sell pay for the long call. All right. And when you do it for a credit, sometimes you can do it for a bigger credit. I just didn't want any downside risk in case this underlying falls out of bed. That's the beauty in this strategy. It will act as a long call spread, but there's no downside risk. A long call spread, if the underlying falls down, then I lose that debit. This one, if the underlying falls down, then I get to keep the 3 cents, which isn't really anything to write home about. To be honest, it won't even pay for your commissions probably. But you really didn't lose any money on the downside. But if I'm directionally correct and this underlying moves higher, then that's where I'm going to make my money, because I own this. I didn't pay anything for this long call spread, so I have it for free. So now when this underlying moves higher, if it goes higher from 166 to 169, this spread is worth $3, right? The full width of the spread. You buy the call, sell the call. The width of the spread is $3 because I didn't pay anything for it. I also have that 03 cents in there, so that's my max profit. If the underlying finished right at 168.99 at expiration, or right there, that's the only way to really get all of it, and it's pretty impossible to get all of it, to be honest. You can get a couple extra. You're always going to lose a couple of pennies there, but that's not worth not doing the strategy over. It's just very difficult because you got to nail the number. But that $3 I would make all the way to 69. Now, because I'm cash flow positive at 169, at 170, 171, right? I have this $3. It starts going down all the way to 172. So my break even is at 172 because, right, the $6 made money to the 169. Then the extra short one call loses $1 here, right? We go down $1 there, down $1 here, and down $1 here. So this ends up being my break even at 03. Does that make sense for everybody, how I came up with that break even? The long call spread, because I own it for free, I can, if it goes up to 169, I get the full width of that spread, $3. And the 3 cents from the original trade. And then if it goes above 69, this short call takes away $1 from my winner. So it goes down $1, down $1, and when it's higher by $3, actually it's from 169 to 170 is $1, 70 to 71 is $2, 70 to 73, right? Okay. So this doesn't look like a great risk reward trade, but on this, because of the unlimited potential loss to the upside, but you can see there's no risk to the downside. And if we pull up a chart here, if I can find my chart on this, whoops, where's my chart? Let's get rid of all this ink. That's the right chart, because I want to talk about one other thing real quick. So what we can see here with this support level, I know that's pretty solid. So that's going to be one of the areas I'm going to look to get out of if we settle, the underlying settles below that. Now, if you can notice, what's this Fibonacci at? My resistance area, 172.09. All right. I said mine was 172.03. Okay. So my break even is slightly below this Fibonacci there. But I've got a lot of room to the upside. If it stays right here, then, you know, I might make a little bit of money, not a whole lot at the end of the day. Because if those short calls expire worthless, you know, I get to keep that. And then for every incremental higher from 166 is where I'm going to make my money. If it goes below 166, it's a scratch, right? So that's how I want to play it. The risk is above that Fibonacci, but that would be no win on that Fibonacci. If it trades 172, it's probably going to be a scratch. Goes below this Fibonacci because the equities start rallying or something. That's when I'm going to be safe, because it goes down. I have no worries at that point. But if we just rally up to like right around 169 around this area and settle there, then I get the full width of the spread. And that is my winner. That's ultimately what we want to try and get, is that full winner there. All right. Anybody else have any questions? I want to just make sure I haven't forgotten anything here, this trade. All right. Well, without further ado, guys, this is the deal we're going to do, the offer. If you guys enjoyed this, if you had any takeaways whatsoever, I've got about 15 more hours for you right here. How to protect against rising interest rates. Fed just started talking, folks. Rising interest rates are around the corner. The Fed taper is going to start happening next year. That means what the Fed taper means is interest rates are like a teeter-totter. As the price of the bond, or as let's just say is interest rates, let's go from interest rates. If interest rates go higher, then the price of the bond goes down. It's a total teeter-totter. All right. So the price of the bond goes down. Well, what does your portfolio say its value is based on? The price of that bond. That's part of the portfolio you guys are never going to look at. All right. So make sure you're paying attention to that portfolio bond going for the next couple of years, because as interest rates rise, that I show you different techniques to lower your overall cost basis on those underlyings that are going down in value. All right. That's the best way to get ahead in trading, is to lower your overall cost basis, folks. How to use that blue area over to the side to trade that I have on all my charts. That's a really good one. When, where, and why we're using options, how to set those up. I'm going to show you all the levers and pulleys with these options. And then I go down, just like with this strategy, and streamline that process, help you go through your own thought process. This is what I'm thinking. I've got a bullish assumption, high volatility, but I'm worried about the strategy being wrong. That's when you would want to put in something like the ratio call spread, because you make the money on the rally, you don't lose anything on the sell-off. Now, this is not appropriate for an IRA because of the short call aspect to it. Now, you could do this around an underlying that you have in your portfolio. All right. Maybe you, in this type of environment right now, you're thinking, yeah, well, this pullback, I'd like to add some stock, but I'm really worried about a continued sell-off into the Christmas holiday. But heading into the end of the year, maybe I want to see if there's any window dressing. These guys try to drive their prices higher to make their books look good. I want to participate in that. Well, if that's true, then the ratio call spread is a pretty good one to do it. It will be a covered call with a long call added to it. All right. So the covered call could impact your portfolio, because if it gets called away, then goes above that short strike. But you would have participated extra on those dollar moves on the long call spread. So that will definitely help you out and most likely make up for that getting called away. If it gets called away, start selling puts. Cash secured puts, we'll get it back. We'll get it back. I do that all day long. All right. So this is also the page it'll take you to for $36, folks. I mean, that's one strike, one bad trade, generally speaking. And this is a better breakdown of everything you've got going on in this entire series. As a matter of fact, the history of options is a really fun one. But what happens is they're little boxes, and you basically check them off as you go along. You don't have to go in order to be able to participate in that. All right. So if this is something that interests you, I've got the link over there in the side there. Yeah, David, I see your question. Give me a second. The comments, I'll circle back around for you folks. Guys, if this is something that interests you a little bit more, smash the subscribe button. Next to it, there's a bell. Those ones that I come in unannounced are when I'm talking about my trades during the day trading, or during the day while trading. So that if that's something that interests you, make sure you guys take advantage of that as well. All right. And hit the like button before you go. Feed those robots. They run out and find people like you to come watch this video. All right. John David's asking, is there any reason why we're using that 50 delta? The reason why I choose that 50 delta, David, is because I want to be able to create this strategy. If you go outside that 50 delta, your spread becomes a little bit tighter. So if I can get inside and just get inside that, around that 50 delta, I'm paying a little bit more for it, but I'm also usually able to get a little bit wider spread that way. Okay. If you get a little bit tighter, it just gets a little wanky as you go down. You don't have to pick the 50 delta. If you like that one that's just outside, maybe the 48, that's fine too. But your it's going to be a lot more difficult to get that strategy off as a credit rather than a debit. Further in the money you go, or lower, higher delta to start, then those are the ones, folks, that are going to allow you to do this trade a little bit easier and get a little bit wider sometimes. Okay. Usually right there at around that 52, 53 delta is the one that I find to be the real sweet spot. It's right on 50. You can do it. It's just not as easy. All right. And no, you can do this strategy when volatility is really low. Okay. But we don't want to do the ratio call spread when volatility is really low, because those premiums aren't very good. And when the premiums are pretty weak, then our spread gets really tight. Okay. And we don't want to do that with this strategy. We want high volatility so our spreads are wide and we can get away from where the underlying is trading. When that volatility comes in, we will see this strategy work out very quickly. Okay. That's all I got for you guys. A little bit early today, I think. If you guys don't have any other questions, anybody else have anything? Is that to get a narrower, well, the 50 delta gets us a little bit wider spread. If you're going outside that 50 delta, it usually makes it, even if you kept the wings the same distance or the legs the same distance away from one another, it would still probably end up being very difficult to get that done as a credit unless it was super tight. Okay. All right, before you guys go, make sure hit that subscribe, hit the like, and comment. Make sure you guys are commenting over there. I want to make sure you guys are taking advantage of questioning me, like John David. He's driving the content. If you guys want me to drive the content in your direction, let me know. Comment over there. I'll be sure to cover that. All right. That's all I got. Have a great day, guys. And if you can't take that, take it easy. Thanks, John. Appreciate you. Bye for now, folks.